Taher Badshah now joins us. Taher, it's things are getting from great to superb for Indian markets, but given the way how Indian markets now are trading at premium valuations to other counterpart, do you think the recent 6-7% rally is justified?
So, well, I think premium valuations have to be looked in, as you know, in the context of what the earnings and the earnings momentum is, and I think this quarter, at least trends up until now seem to suggest that things are finally coming across the way market participants have been expecting as far as earnings delivery goes. So while aggregate numbers, which many of the houses have actually put out for results which have been declared till now, seem to suggest that numbers are in line, but the way probably I think increasingly one should dissect it is in terms of how many companies are actually over delivering or beating street estimates versus earlier. And when I look at, let's say, the analysis of 35 companies of the Nifty which have declared numbers till now, probably about 75 of them have actually beaten estimates or met estimates, versus this being probably the number being more closer to about 55% in the last 4-5 quarters. So essentially, I mean, I think that's a better way to track the earnings delivery versus expectation, and I think on that score, probably things seem to be getting better. Headline numbers are much better than what we've been used to over the last few quarters. It started off well for a couple of these public sector banks as well, which are the usual suspects. So I think if looked in the context of the fact that numbers are improving, then valuations at some level will probably hold, given that many of the other macro variables are reasonably in place.
Taher, what do you make of the market levels? Do you think we can make a run for 11,000 in the time left for this year to close out?
Well, I mean, we've got about 1.5 or little under 2 months to go, so hard to call on a next 2-month basis. But I think if this earnings season passes off reasonably well, then this is the expectation of this is the start of the earnings growth cycle, because by which time of the next quarter and the subsequent quarter, that is December end and March end, I think we will be past some of the uncertainties related to GST and Demon and RERA and so on and so forth, which have been kind of dislocating earnings. We will see better year-on-year growth numbers going forward. So if we are primed for about 15% earnings growth in the next year, then over the next 12 to 15 months time, I won't be surprised if the Nifty can deliver another 15% in terms of returns.
Let's look at one large sector which has got created in last 6 months. That's the insurance space. Are you a buyer there? If yes, which way are you leaning? Life, general, reinsurance?
So we've not been significantly holders of insurance companies as yet, barring some exposure to general insurance which we have. We've kind of been a little more wary of valuations out there, and we think while they are great businesses and they've got a good runway ahead of them in terms of growth profile, I think we've kind of been little sitting on the sidelines as far as life insurance companies go, and we're happy to look at them at some level when they become a little more attractive. So we've given them a pass for now.
Taher, what is it that you're doing, or rather, how is it that you're viewing the pharmaceutical space now? A spate of good news coming in, earnings recovery seems to be coming back, and M&A is keeping the sector excited as well. We saw that just with Torrent Pharma as well as the Unichem deal as well. Are you a subscriber to pharmaceuticals at all, or are you still avoiding them?
Well, up until very recently, we were kind of sitting on the sidelines even in pharma, simply because earnings were correcting even more sharply than prices were, and therefore there was not really much scope to buy them on beaten down valuations as a metric. But yes, you're right that increasingly there is evidence that things are at the margin getting better for the sector. We are seeing US FDA being a little more benign and even favorable in certain cases in terms of outcomes. And it's a sector where we've seen sharp downgrades and sharp erosion in earnings. But this again is a sector where when earnings come back, they will probably come back as sharply as they have fallen, simply because it's based on it's driven by largely a couple of products or a couple of approvals which need to fall into place, and business can resume meaningfully in a very short period of time. So this is a sector which will have high volatility in earnings, and one needs to be cognizant of that before investing. But I think the headlines surrounding the sector are clearly getting a little better, and that should throw up some interesting opportunities which we are evaluating for the sector.
All right. Would you be looking at reviewing your call on IT and Pharma? I don't see them as the preferred bets. IT maybe subtly, but even in your major holdings, Pharma and IT are missing.
Yes, so in a couple of funds we have a decent positioning in the IT sector, especially in funds where we are a little more value oriented and where we are willing to take a contra call, and that is where we would want to beef up some of our Pharma as a sector will obviously at some stage fall into the space of contra stroke value investing, and we are trying to look at ideas wherein we can play the sector and at the same time see reasonable downside protection. So we don't really want to we're still guarded about not seeing significant earnings downgrades or miss on earnings. It's still a difficult sector, but we think at the margin opportunities are may come on the screen, and therefore we would like to look at them. So clearly that is one sector. Pharma is a place where we still need to build our overweights or our weights. IT, we are reasonably well positioned.
Appreciate your time and thank you for joining us.